Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonneau, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
Jack Forehand is a principal at Validia Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital or Sunpoint Investments.
So, Matt, are you at the San Francisco office today, or are you at your place in St. Bart's? Because I wasn't sure which one you were going to record from.
Live from the San Francisco office. We're in the same room. You can't tell with this setup. We're in our San Francisco office.
Yeah, we got this. We're saying this because we got a comment, something about that we were out of touch in our San Francisco office with our podcast or something like that. And I'm not even sure where that comes from because we've never talked about San Francisco. I haven't been in San Francisco in 15 years. We both operate from our houses, which are certainly not in San Francisco. But I thought it was funny. Some of the YouTube comments are always funny.
In San Francisco. Yeah. Thank you, guys.
So, but we're not. The other thing before we get into our topic for today, the other thing I wanted to comment on is I'm all for all the attacks on me about like the quality of my content here. I mean, there's certainly things you can attack me for, but there was one comment, and the commenter actually said something positive about me, but he referred to me as the bald guy, Matt. And I just don't like it.
No,
if you look at these locks of hair, Matt, there's still plenty of hair left here. This is not the bald guy, I do not think that's appropriate at this time. I'm doing everything I can to fight it.
It's not appropriate at this time. We're going to have a separate conversation about bald denialism later, but we'll do that offline.
Which means it might be correct, the comment, unfortunately, but unfortunately, the long flowing hair is just not going to work for me anymore. It never really worked for me anyway because it was so straight that it was disgusting. It didn't curl ever, so it was awful. But now I guess things are headed downhill. It's never fun to watch the old episodes from the beginning of Excess Returns because you can see the deterioration of this over time. Like the hair situation has just gotten worse and worse. Like I look older and older. There's more gray in there. Like it's just I don't know if I like having my progression on the internet for the rest of my life.
It's been documented. We could extrapolate this forward. I'm going to call Hal Hirschfeld. He's going to map you out, show you your future self on podcasts in 20 years.
So anyway, besides these tangents we always get off on, we're going to talk today. We just had Aswath Damodaran on Excess Returns. You and I did the interview, and I mean I've been getting some comments that it was one of the best ones we've ever done. So that's really cool, and that's not necessarily a reflection on you and me because I also think I was thinking it's probably the least words the host's ever said in one of our interviews too. We were just he was on such a roll that we were basically just trying to guide him a little bit, and he just kept going.
There's something about it, and it's one of those, if you haven't watched it, go watch it, give it a listen, give it two. I mean, I've played it back a couple of times now just because he's so thoughtful in the way he packages these ideas. And we were talking to each other afterwards. We're just you're listening to it, and there's a point where you're just well, there's too many quotes. There's too many things here for clips. It's an overwhelming amount because almost everything he says is so tightly packaged, but it's not go on TV. And granted, he can do that too, but he wasn't bringing that skill to the table of here's my buzzword for you to put in before the commercial break. It's just, he's really good at putting really cogent thoughts together in a tightly packaged place and presenting them over and over and over and over again, which is why we said we had to do this show today.
Yeah. And he teaches other professors how to teach, and you can tell, but based on having him on here, you can tell why that's true because it was, like you said, everything was so well said. And everything was so well thought out too. You could tell he's thought deeply about these things we talked about. So anyway, what we want to do today is we usually do lessons from some of our podcasts, but in this case, I don't even know if they're necessarily lessons as much as things we're thinking about, because there was so much stuff in here that are issues that investors are thinking about today. Maybe things that don't even have an answer one way or the other, but listening to him talk about them got me to think about them in a different way than I had been. And so we're going to play some clips of him today. And we're going to go through these things and we're going to talk about what we took away from it. So the first one here is really interesting. And this is the one that kind of got a little bit of anger on LinkedIn at me. Not necessarily at me, but at the clip in general. But he had talked about the Berkshire meeting, and he talks about the people that go to the Berkshire meeting and sort of their belief in value investing and how they think about investing and why he's never gone there. So let's play that clip first.
The place terrifies me. It's full of true believers who think they've found the three words that come to my mind when I think about old-time value investing, I'm not tarring Warren Buffett or Charlie Munger with this, is it's rigid. It's it's ritualistic, right? There are certain things you're supposed to do as a value investor, including going to Omaha, reading Ben Graham's security. I'll wager for every 100 people who claim to have read Ben Graham's security analysis, maybe one actually read the book. I've actually read the book. I've written hideously boring books, but next to Ben Graham, my books are like, Harry Potter to read. And you're supposed to follow those. It's very ritualistic, it's very rigid, and it's very righteous. The righteous part really bothers me, which is they believe that they're the chosen ones. You hang out with people who come to Omaha. They've been coming for 30, 35, 40 years. They think they found the one pathway to successful investing. And I have no problem with all of that. But then they look down at the rest of the world as shallow and stupid and not quite there. And I think that's one of the most dangerous things you can do in investing, is to view the rest of the investment world with contempt because you've done the right things. So I don't feel any joy in hanging out with a crowd that's convinced that because it becomes almost a religion rather than, I have faith. I tell people investing is about faith. I have faith, but I don't believe in dogma. And a lot of old time value investing has become dogma. Cannot do this. You should be doing this. You have to have a margin of safety. Says who? Right? So I think that's what bothers me about old time value investing. And again, I think that, Warren Buffett is actually a much more flexible investor than many of the people who claim to follow Warren Buffett. But I think old time value investing has created these sets of rules that they believe everybody should follow. And to me, there is no one pathway to success. I love Peter Lynch. I love Warren Buffett. I like some things that George Soros does. I think there's something to be learned by looking at great investors in every philosophy. And if you ask me what's the best philosophy for me, my advice is look inward. Figure out what makes you tick, because that's going to tell you what the right philosophy for you is. It's not what worked for Warren Buffett. It's what's going to work for you.
So this one was interesting to me because he talks about what he said was interesting. He says it's rigid, it's ritualistic, and it's righteous. And those are all, first of all, he came up on the fly with all the R's, which is very impressive. But second of all, it's all the things you don't want to be as an investor. You don't want to be rigid. You don't want to be stuck in your ways. You don't want to be ritualistic. You don't want to be righteous, judging the people who have different opinions than you. And I don't think, the one thing I would disagree with him on is I do think there is some of that in the people who follow Buffett in general. But I also think we know a lot of people who go to the Berkshire meeting. We know a lot of people who follow Buffett, and they are some of the most open investors to other approaches that I've found. So I don't think I don't think he meant it as everybody that goes to the meeting is this way. But I think it's important because this is a trap all of us can fall into in investing, is we surround ourselves with people who are true believers in what we believe in. We see something else going on in the market that maybe contradicts that, and we just dig our heels in. And that's a really dangerous thing.
The way that he packages it up, this idea of have faith, not dogma. And he brought us back to this in a couple of different ways, even if he only said it once. But have faith, not dogma. Dogma is what's dangerous. Dogma is the thing where you become part of the church and then you're like, love everybody, but not those people. And don't worry, they're going to hell. That's bad. You want to have an open enough mind to do this. We know this is true for the people going to the Berkshire meeting. We know they're not all like this. We all know some of them, because sometimes the Buffett people, on Twitter and other places are as bad as the Bitcoin people, as we've observed. If you anger the church, the people come running at you for these things, even if they're pointed criticisms. But then you meet somebody like, I'm thinking about, friend of the show, Bogomil Baranowski, and I'm thinking about how he defines himself and his firm. He's like, I'm a value buyer, but I'm a growth holder. And it's one of those, there's a broader understanding, there's nuance to the understanding, there's a richness of it. I know you get that from the community. Understanding with himself, though, that it'd be easy to tip into that thing, because I asked him in the interview, what's the upside of dogma? And he says, well, you never have to worry about being wrong about anything. You're always right. It's infallible, and it's right there. I think behind that is also this understanding, if I join in this ritual, if I do this thing in this way, I might start to cement my thinking, and I'm not really going to gain anything from that room. Therefore, it's better for me to stay out of that room. man, do I respect the hell out of that.
There's no one good right way to invest. And I think that's what he was getting at here. And whether you're a Berkshire person or you're a growth investor or whatever you are, you have to be open to other people in the way they view the world. Or you're not going to be successful with this because things change. He referenced this idea that there are still some value investors out there who are shaking their fists at Google and, all the big companies, Facebook and everything. And like, these things are about to collapse. It's about to come crashing down. Like this whole thing has been a house of cards. And, we referenced in one of our other episodes, Aaron Stanhope's chart he put up on this, showing that like the free cash flow of these companies has tracked the performance pretty well. So these are great companies you could argue they're overvalued, certainly, but these are great companies that have built exceptional businesses. And as he pointed out, these businesses impact all of our lives in every way. So you can't sit here as a value investor and be like, well, we were right and those companies are wrong and they're going to come back to earth. That's just not right. I mean, we were wrong. Anybody who didn't own those was wrong. Whether you got there through factor investing, which we're going to talk about in a little while, or you got there in another way. I mean, if you didn't own those companies, you've struggled. So it's better to look in the mirror and say, why didn't I own those companies than to attack the other people and dig your heels in and say, this is all about the collapse.
I'll paraphrase The Godfather. Leave the dogma, take the faith. No matter what your investment philosophy is, leave the dogma, take the faith. That's the thing. All investing is faith. Just like I love our all investing is a form of value investing. We only ever buy something because we think it'll be worth more later. So leave the dogma behind, have an open mind, keep the faith in what you're doing and why you think it's going to work. And then you got to play forward into reality with that. If you lose that, that's when you're going to get in trouble.
So our next one deals with the active and passive debate. And this is something I ask a lot of people. Whenever we have someone really smart in the podcast, I like asking them about this and about Mike Green's work, because Mike Green's work is something I think about a ton, because I think it makes a lot of sense. And I've kind of come from somebody who said, maybe this is not right, to believing more in it. So I like to ask anybody who comes on about this. So we asked him about the rise of passive. We asked him about the implications for active and what he thinks about it.
Hold on before you play the clip. Tell me this. When you think about it, active and passive, and I guess anybody who has some type of approach that we would even modestly define as active, do you think you're curious in it just because it's the dynamics of the other players on the field and like what's your actual awareness, or how are you actually thinking about it? Or are you thinking in a vacuum? Why do you think it's so interesting to you?
I think it's really interesting because it's something that influences the market that maybe has nothing to do with the companies themselves and the fundamentals of the companies themselves. And I think as somebody who's investing based on fundamentals, you have to think about that. If there's something else going on here with these flows, where these big companies are going to be driven up relative to the rest of the market by flows that have nothing to do with their businesses themselves, I think that's something you have to consider. It's something you have to think about. And then also on the other side of it, Mike's work around like how this could end. And again, he doesn't really, this is something he'll agree with Rick Ferry on, which is you can't really do anything about how it might end. Like you could talk about bad things in terms of how it might end in the future, but Mike is a believer in most people should be buying the index too, just like a Rick Ferry would be. But I think about that too. Just, is there some sort of risk that we all should be thinking about over time to all this stuff? So I just think it's very interesting, because you want to believe, as an active investor, you want to believe that the fundamentals of companies will ultimately drive the outcomes over long periods of time. And if there's something that changes that, it just leads you to rethink what you're doing. And I think it's something you need to pay attention to.
That's an awesome answer. Let's play the clip.
I describe active investing as the equivalent of floods or as a plumbing company that if you call into your house because there's a leak, leaves a flood and sends you a bill for it. You'd never pay the guy, right? Active investing, bad performance is caught up with them. I do think, though, that as passive investing grows, and it will continue to grow, this is inexorable. It'll hit a cap. The reason it'll hit a cap, it's true that as passive investing grows, there are fewer and fewer people looking for bargains, looking for mistakes. But we talked about efficiency. The reason mistakes are so difficult to exploit in markets is because other people are also looking for them. There's a tipping point where if too few people are looking for mistakes, you could argue that the magnitude of mistakes will get larger and that active investing is going to pay off again. So there's an ebb and a flow to this. And I think there will be a point where passive investing overreaches and active investors will come back. But it's the steady state is going to be about a lot fewer active investors than we see today. All those floors in Boston that Fidelity has, 2/3 of them they don't need. It's not great if you're in the active investing business, because the business is going to get smaller. Remember, we talked about bringing something to the table. The active investors are going to be left, or people are going to be people who bring something to the table. And it's not going to be permanent. You got to be adaptable, because you bring something to the table. There's an ETF already getting formed saying, let's replicate what this guy is doing. And they don't need to know what you're doing. They just need to know what you're buying and selling. They can look at your actions and reverse engineer what you do. And the next thing you know, there'll be an ETF doing exactly what you do, charging 10 basis points, and you can't survive with 10 basis points.
All right, so this is interesting. Like, he didn't comment a lot on Mike Green stuff, although he did say at the beginning that he thought there was a momentum to this. So he did think that maybe the bigger companies were getting driven up by a momentum due to the passive flows, but he was more talking about active. And the case he made, you can't really dispute it. I mean, active management as a whole has been horrible. The track record is, I don't know what he said, 85, 90% of active managers underperform. So that's just the fact of it. And he talked about how passive in the near term is going to keep getting bigger and active is probably going to get smaller. What I thought was the most interesting part is he talked about there should be a tipping point at some point. There should be a point where passive gets big enough that things kind of go the other direction. And I thought those were maybe some of his better insights.
I think this insight connects to a number of the other things that he talks about in the interview. And I think it's fascinating that when we think about business formation, it's really hard to start a competing business when something's going so well. And so to compete against a BlackRock or a Vanguard when all the data is against you, when everything else is there as an active investor, because it's really just friggin' hard to do. It's kind of a profound point to think about who would start a business to compete with this thing at the peak of its run. And that opens up the door to, do we hit one of these great tipping points or inflection points where the whole market has to break before there is a viable business idea to not be running a passive shop or some form? Or is there room as we accelerate towards whatever this tipping point is that maybe isn't going to completely break the markets or break capitalism or something? And maybe the idea is you can start that business, in the wake of whatever comes to pass, or when there's just enough room for this. It's really interesting to think about in this in layers. And I think the way he answered it shows just how aware he is of the nuance of these layers and how impossible it is to predict how it's going to play out. It can't be, the market can't become 100% passive. And even if it did, there's still the active decisions of all the buys and sells and redemptions and redeems and everything else.
Your point gets back to what I talked about before, which is, what does this tipping point look like? It is a question a lot of us have to think about. Like, obviously we don't know what it is. We don't know which percentage of passive it is, but it could be a very ugly tipping point. It could be some sort of gradual thing where, active management comes back to some degree. I don't know what it looks like. And that's what I like to think about. And that's why I like to ask people like him about it. And the other point is, I thought he agreed with what Michael Bogosin has talked about, which is, unfortunately, you can't say, like, right now, as we're getting less and less active managers, you can't say, well, it's getting easier for active managers, because what's left is the best active managers. And as you keep going down, that's going to be the case. And so it doesn't necessarily get easier to be an active manager. I mean, he talked about the floors at Fidelity and, how many less people are going to be there. And that's probably right. I mean, I don't consider myself, I'm kind of an active manager, where factor investors are sort of in that hybrid space between active managers and passive managers.
Is this where you disclose your active Fidelity real estate short position?
Yes, exactly.
Should I alert compliance? Okay.
Exactly. But I think about it, like, I mean, obviously the market's getting harder. Not easy. There's less active management, but it's probably getting harder, not easier. And so it's just an interesting thing for all of us to think about. And anybody who's in the active management space, and we'll talk about this a little bit more with AI later, like, anybody who's in the space has to be thinking about, like, what is my edge and what can I do that, that allows me to succeed in this type of environment.
Yeah. And when does it work? The other brilliant part about this is just an awareness of when something works and who your competition is, and basically when's the tide going with you and when's it going against you. Understanding the basic tenets of that story, it's kind of everything, which is kind of why I love, maybe it might seem ridiculous to somebody who hasn't really thought about this a lot, why we ask this question perpetually, but it really is one of the only ways we can address what's going on at all these different levels. I think it's a critical one.
Yeah. The other thing he alluded to at the end, which I think is really important too, which is, even if you found something that works, even if you do have an edge, people who are like launching ETFs at very low cost are going to, if they can figure out how to systematize that, there's probably going to be an ETF that's going to come out that's going to do the same exact thing you're doing. And you got to figure out something else to do, which makes it even harder. So, and especially in the world of AI, where, obviously technology is advancing very rapidly. I mean, the ability to replicate some of this stuff is going to go up and up and up. So it's just a challenging place to be. So yeah, the next clip kind of hit home for me, which is he's not a fan of factor investing. That it turns out.
An efficient market is one that it's not one where markets don't make mistakes. That's the straw man that people like to use. Markets make, of course they make mistakes. They make some doozies. It's can you take advantage of those mistakes to earn more than you would have in an index fund? And the answer is it's really, really, really difficult. So when people talk about factor investing, it is backward looking. It is mean reverting. And I think that they have to factor in a reality that the tides may be shifting, that the market may be changing. I'll give you an example, the small cap premium. Do you know there hasn't been a small cap premium since 1981? I'm going to add that on as a data set next year, where I'm going to let you pick the starting point and the ending point for the data. And I'm going to put up the data from 1927 to 2023. Over the entire period, small cap stocks have earned about 3.5% more than large cap stocks, maybe even more, 4 or 5% more than large cap stocks. Think that's great. I should buy small cap stocks. But then I'll let you change the starting point from 1927 to 1950 to 1960. And you get to about 1977. Starting in 1977, there's been no small cap premium. Doesn't mean that small cap stocks never do better. It's that they win some years, they lose other years. So that's what I think we need to think about. What's changed about the market? First, the global economy is not US-centric anymore. 50 years ago, the US economy was the center of the global economy. Now, it is a big part of the global economy, but it is not 50% of the global economy. Second, you got disruption, technology, and globalization all playing havoc with what used to be mean reversion. Mean reversion used to be that you got a steel company and your margins drop, they would revert back to what they used to be. Well, that might or might not be the case when you have disruption and globalization. So I think we have to factor in the very real possibility that the world has shifted under us. And if the world has shifted under us, many of the reasons these factors worked in the past are no longer in place. So investing based on factors, I'll give you a very honest reason why I think factor investing cannot deliver excess returns. I have a very simple saying I use in my investment philosophies class. If you don't bring something to the table, you should not expect to take something away. What are you doing in factor investing? You're basically screening, right? You're screening for small cap stocks, low price to book stocks, whatever your factor is. 50 years ago, that took a lot of work. You had to go collect the raw data. You had to put in the screens, often run them by hand. Today, I can run the screens on Capital IQ. Across the global universe of stocks, it takes me 3 minutes to do. What makes you think that screening for factors entitles you to special status to earn excess returns? An index fund, an ETF, can do exactly the same thing. If you bring nothing to the table, and many factor investors bring very little to the table, I don't expect you to take anything away. That's why I'm not a great believer in pure factor investing. You might add something to the mix that makes you different, makes you unique. I know AQR had this quality small caps. They said we want small cap companies with quality in addition to small capitalization. Maybe there's a qualitative component to that quality. We look at management, look at what they're doing. Now, I can see the reason why you might be able to earn excess returns, but factor analysis by itself is just mechanical. A machine can do it better than you can.
I think that this is really interesting because it's important for me as a factor investor, and we try to do this. Like you and I just did a thing about is value investing dead last week. We're trying to constantly challenge ourselves. And a big part of his argument was, if you want to take something from the table, you've got to bring something to the table. And his argument was factor investors are not really bringing something to the table. Like he mentioned, back in the day, back in the 1960s or whatever, the process of finding the cheapest companies was very, very hard. You were actually getting documents from physical locations. You were doing the calculations by hand. You could definitely argue that was alpha back then because most people weren't going to do it. Today, I can go run that screen in 2 seconds. So am I really bringing anything to the table as a factor investor? And he said no. And I'll get your take on that first, but I'll disagree with him after. But I think it's something you have to ask yourself at least. I think it's important to say, what am I bringing to the table? Or going back to when we talked about Ben Inker's lesson on one of our other podcasts, why should I get paid to do this? Like you have to have some reason. The market just doesn't give you free returns. If you're doing something, why should I get paid to do this is, I think, a very important corollary question to what he was saying.
This idea that, back to our value investing episode, it's like, well, value investing isn't dead, but maybe factor investing is dead inside. And it's this kind of gross idea, but really important of what are you doing that's actually adding value to this thing? And in his point, he talks about mean reversion, and mean reversion, somebody has to do something both to push something away from the mean and then to push it back towards the mean over time. That's the way this works. So understanding if mean reversion becomes predictable in a market because everybody's got the information that's going to converge that back onto the center, onto the neutral point or whatever, however you want to think about this, you got to ask this question of like, can I help push that thing back towards the middle, or are there other forces at play that are already doing that for me? And my best case is to ride that wave, or is it happening so fast or so thoroughly that I don't even have the opportunity to ride that wave in any way that's conceivably profitable? And that's a really powerful point because, yeah, when you could run around all the places, I think about talking to Jim O'Shaughnessy about setting up the first business where they were doing the clone strategies of the managers to just try to predict, okay, here's how the managers act. And then the clone strategies do better than the actual managers, but you still had to have access to this super sacred database and have the abilities to crunch these numbers with calculators and spreadsheets and whatever else. And now that AI can do it, now that somebody can launch an ETF tomorrow with a bunch of capabilities and some whiz-bang programming to replicate these things and do it, what are you going to do that's profitable beyond cost to drive these well-understood pieces of mean reversion any further? That's a profound question.
It is.
Really brings that point home. Like, is value investing dead? I still think the answer is no, but is factor investing dead inside? Man, sure feels soulless when we see the totally BS factors in that paper and go like, oh, those work maybe better than price to book or whatever else.
So to push back a little bit, and this kind of gets at what you were talking about with that paper, but so I would say a couple of things. First of all, on mean reversion, we do have to remember that not all factors rely on mean reversion. Value relies on mean reversion. You've got momentum, you've got quality, you've got a lot of other things going on. So factor investing is not just about mean reversion. But the other thing I would say is going back to why these things work. You've got the risk-based explanation, you've got the behavioral-based explanation. So the idea is, what am I bringing to the table? In a lot of ways, what I'm bringing to the table is the willingness to bear risk. What I'm bringing to the table is the willingness to wait things out while the market maybe corrects these mispricings over a variety of securities. So I do think I would push back on him to some degree by saying, like, I agree with him that this is not necessarily alpha. Like, basic factor investing is not alpha. It's kind of beta these days. But where I disagree is I think you still can get a better return for that. If all this academic research holds up, if I'm getting paid for taking on that risk, if that mispricing exists, I can still get a better return than the market. Now, it's going to be a lumpy return. It's going to be a painful return. Most people shouldn't do it because you're going to get beat up so badly along the way, especially if you're just following value, which I would not recommend. But I do think there's a reason you can explain, like within his framework, why you should get a better return than the market as a factor investor.
Here in the San Francisco office, we revert to meanness.
That's
right. That clip.
And I've just literally disagreed with Aswath Damodaran here. So that's obviously you could pick who has a better track record to rely on with that. I would probably pick him. But I do think it gets to the idea that there really are two sides to a lot of this stuff. Even when you talk to great investors, you could put, and we're going to, I think we're going to have Cliff Asness on the podcast coming up in a month or two. Like, you could put him on the other side of this and he would have a different opinion than Aswath, and they're both dramatically smarter than me. So I think it's just important with all these things, everybody, just like Aswath talked about, you don't want to just follow these legends blindly. Also with people we put on the podcast, no matter how smart they are, no matter what their resume is, you want to understand there probably is somebody smart who can argue the other side of some of this stuff as well. So moving on to our next one. I really like this one a lot. And this is the idea that everybody who's an active investor, like most people are talking about the idea, I'm an active investor, I'm going to beat the market. Aswath talks about why he thinks about his portfolio in a different way than that.
I invest actively because I enjoy investing. I invest actively not because I want to beat the market, but because I enjoy investing. Which means that when I invest, the one thing I have to do is remember the Hippocratic oath, which is do no harm. Don't do things in your portfolio that could cause you calamitous costs. For instance, I diversify. I hold 40 plus stocks in my portfolio. That would be a no-no with old-time value investing, where you said concentrate. No, why not? Now people say, don't you feel confident enough in your big winners? No, I don't. You might, I don't. Because I know how many things I don't control. Imagine buying Marriott in December of 2019 because you felt confident it was undervalued. You might have been right. But 2 months later, COVID hit, and there goes your rightness. There are too many things I don't control. It's hubris to think that you pick the 5 best companies in the market. So I diversify. I try to buy undervalued companies. But here's the bottom line, though. If I get to be 85 and you came to me on my deathbed and said, you know what, you could have made 50 basis points more or 25 basis points more a year by investing in index funds, instead of doing what you did, value companies and buy cheap companies. And you ask me, are you okay with that? My answer is yes. I'm okay with not beating the market. And that, I think, is critical, because if you keep telling yourself, I did the right thing, therefore I should beat the market, therein lie the seeds for being righteous, for being indignant, for getting angry. I mean, when you get angry at markets, nothing good comes out of it. And if you think about it, there are a lot of people out there very angry at markets, are very angry at other investors, they're very angry at what other people do. And my response is, you're wasting your time and your energy, and it's sucking up what you should be doing on your own investments. So if I end up underperforming the market, I'm perfectly okay with that.
So I love this from the perspective that, first of all, we just talked about this. Like, most people who manage their personal portfolio and try to beat the market are going to come up short. I mean, the data is overwhelming on that. But I think there's still like value in it. And I think what he said is right. Now, first of all, he's probably outperformed the market by a lot, would be my guess, with his personal portfolio. He didn't say that. I mean, he did say he's outperformed, but my guess is he probably has. But he still said he does it for the love of doing it. Like, he enjoys it. And like he said, if I'm on my deathbed and I underperform the S&P 500 by 50 basis points a year over my whole career, I'm fine with that. And I think that's great. I think that's a great way to look at it. You know, if you're not looking at it as, for someone who really loves it, who wants to manage their money, who's not doing crazy things that's going to destroy their financial future, I think that's perfectly fine if you don't outperform the market.
It's okay to admit that your one life ambition at this point is to outlive Professor Damodaran and show up on his deathbed with his performance scorecard and just go, so I just want to review this with you in between medical charts here.
I have a feeling he's not going to want to hear it.
I have a
you
feeling
have bigger problems at
that
point.
This idea of like not beating the market doesn't mean the market is beating you. It's so simple. It's so profound. It's so just, hey, I love this thing. I'm speaking in his voice. He loves this thing. He's good at this thing. He loves teaching this thing. He loves taking his passion for explaining this thing he's good at and helping other people to understand it, and then take and apply into other pieces of life, if not into other career paths and everything else. He's built his whole life and identity around this and sharing this thing that he has joy for. There's nothing wrong with that. And if you do have joy for something, it's really wonderful to be able to find people like him in the world, to be able to read the books, to go on YouTube, watch the lecture series, see the PowerPoint presentations, play with his data sets online off of his website, all the things that he does, and know that he's doing it all for just the joy of doing it and sharing it. There's such a shortage of people with that approach in the world. And to think for a minute, you know, this is why it's great. He's not taking investor money. He's not doing something else where like performance is a component of how we have to understand or believe this guy. We can look at the stuff he's done. He's very transparent about the trades and the things that he does online. And we can see like, okay, like here's how it's going, but he's not offering to take my money. He doesn't want to charge me a fee for any of this stuff. It's a really lovely thing to see a person just doing it for the joy of doing it and wanting to help others do it better.
And another point here is he is not most people. Like, most people do not have the passion for valuation that he does. So like, I don't think the lesson to take for your average person out there is like, I should start managing my portfolio for the joy of it. Like, he loves this stuff. Like, if you look at his valuations, like, he spends tons of time on it. He loves analyzing companies. Like, that's a 0.1% type of thing. And you have to be careful. Like, he talked about do no harm. And so what I said before about, well, he's okay underperforming the market by 0.5%. there might be other people who don't have the kind of money he has, who are relying on their portfolio for retirement, who are not okay underperforming the market by 0.5%. And that could really change their future. So you've really got to think about, who am I? Like, what is my financial future? How much do I really love this? And I think it's a small portion of people who would agree with him and think this is the right thing to do. But I think there are people like that. And for people like that, I don't think there's any problem in saying, like, I underperformed the market, but I got a lot of joy out of doing it along the way.
There's nothing wrong with it at all. And if your thing is not the market side of it, if it's being a carpenter or managing properties, or pick whatever other path in the world that you want to do, and the degree that you want to do any of this stuff off to the side, it's all going to be a balancing act, no matter what. And just understanding that it's the balancing act you choose in your life. And hey, if you're interested in this stuff, it's the other brilliant side of this. There's just so many wonderful metaphors in this stuff because of the way he's exploring how to explain them. So yeah, he's the one guy who cares about that, but just listening to him do it, you get a whole bunch of that little wax on, wax off wisdom falling off at the margins.
And the other thing he talked about that's really important is diversification. He talked about, he owns something like 40 companies. So it's easy to take this idea of do what you love and love investing and be like, I'm going to put all my money in this profitless tech stock that I think is going to be the biggest company in the world. Like, you can't do that. Even someone like him who does the detailed valuation he does, holds 40 companies. And he didn't talk in our interview about this, but he talked in another one. He also owns companies across the life cycle. Like, we talked about the life cycle of companies with him. He owns companies that are on the rise. He owns companies in decline. And that's part of his diversification. He's not just, he's known for his valuations of NVIDIA and stuff like that, but he owns a lot of companies that are not like NVIDIA. So I think it's really important that even someone like him, he understands the importance of diversification, and all of us should probably, understand that as well. Like, he talked about a hubris and how much hubris it is to think I can pick the 3 or 4 best companies. Like, most people can't do it. He can't do it. And he recognizes that. And that's probably good for the rest of us too.
Really good for the rest of us to hear that message, and really good, like you said, don't put all your money into one thing, spread it out. You can't be all Jack Forehand coin all the time. You can't be all Matt Ziegler token. You got to spread it out and actually think about, again, it's one of those things that just lays into so many other life philosophies. Like, you can love one thing that's your core guiding philosophical principles that you have faith on, that you're not dogmatic about. But even inside of those things, having faith means like spreading out some of those bets and understanding a multitude of ways to express these desires for a life of growth, with or without a benchmark being your determining factor of success.
So this next one is my favorite one. It's the one I've thought about the most since the podcast. So I don't think anybody's created the Matt Ziegler bot yet. The Jack Forehand bot does not exist, but the Aswath Damodaran bot does exist. So he talks about this and the idea of developing a moat against your bot.
5 weeks before the spring semester of 2024 classes ended, I got a call from a friend of mine. In fact, I'm writing a blog post about this. His name is Vasundar. He teaches machine learning. He knows more about artificial intelligence than I will ever learn in my lifetime. He called me and he said, I've created a Damodaran bot. And I said, a what? He said, a Damodaran bot. And I said, what is a Damodaran bot? He said, I've created this AI entity that has read every single blog post you've ever written, watched every single YouTube video that you've ever put on, which means it's watched every class. It's looked at every evaluation that you've ever done. And it remembers everything that it has. And it's ready to go. And I said, ready to go where? He said, it's ready to value a company. Can you give me about 20 students from your class so we can run a contest of the bot against them? I don't have the final results in from that contest, but I'm terrified either way, because if the bot works really well, that's about as clear a signal as I can get that redundancy is around the corner, right? If the bot does really badly, it means that everything I've done in my life is about teaching how to be, that's not working, because this bot has read everything I've done and it's confused about valuing companies, and clearly I'm not doing my job. But the piece I'm writing is act as if there's a bot with your name looking over your shoulder, watching what you're doing. Remember, you don't have to be even the public domain like I am. It's watching what you're doing. And ask yourself, what can I do that a bot can't do better? And that, I think, is going to be the challenge for those people who think AI is going to change the way we work and live, is if your job is mechanical. That's why I factor investing, completely mechanical. If what you do is mechanical, rule-driven, bot can do it much better than you can, because Machines are better at mechanical stuff than you and I are. And they follow the rules. They'll be absolutely fidelity to those rules. So whatever you do, take a look at what you do and ask yourself, we talk about moats, right? In investing. My question is, what's your moat against your bot? What is it that you do that you don't think you bought? And it's something that's occupied my mind for the last few months. In my piece, I suggest a few things we can do. And I think that that's something that each of us has to think about. What can I do to keep my bot underperforming what I can do?
Do you think he has first bot mover advantage? Like, is his bot going to dominate ours because it's out there first? Or is his bot coming to kill
dominate ours because he's produced so much public research that's so much better than anything you and I have ever produced? That he's basically done. Every class he's done is online. All his valuations are online. He's produced 1,000x the quality we produce. So I think just that alone is gonna probably exceed our bots.
Okay, but how many times has he discussed cat turd publicly? Really?
That's true.
You've got at least 2 cat turd references
twice now, on 2 different occasions. It's cat turd's Twitter account. But anyway, it's I don't even want to know what my bot would probably be all over the place. Yours would probably be more all over the place than mine. Given the different things you're talking about. But I do think it's really important. I'm thinking about this all the time. In everything I do, I'm thinking about if you could create a bot that does what I do, what are the things I could do that it can't do? And I think all of us are going to be surprised by all the things the bot can do that we didn't think it could do. So that's not as easy a question as you think. All of us have egos and we want to say, I can do this and there's no way the bot can do this. These bots are going to blow us away in terms of what they're going to be able to do. So I think about it personally. I think about it in business. I'm a quantitative investor. Obviously, a quantitative investor is a place where these bots are going to have a big impact. Am I going to be able to do something? You could argue on one hand, no, I'm not going to be able to have a moat there. You could argue on the other hand, if I'm really early with this and I learn how to use these things along with myself, maybe I become better than the people around me. But I think this general question, no matter what you're doing in life, I think you have to be asking yourself, what is my moat against my bot? What can I do that it can't?
I got to ask you this question too. This was another one out of the comments, but it was one that I didn't really think of in this way. But the thing I keep thinking about is this modest existential crisis I feel like this is giving to me. Did you read the comment about, so basically, if the bot ends up being better than you, then you've lost your bot. But if the bot ends up being worse than you, then clearly you're a failure as a teacher. Did you read that comment?
Yeah, that was in his quote. It's right. He's basically in a no-win situation here. Right. If he's a good teacher, the bot should be better than him, or it should be better than his students, which is what it's competing against right now.
Right.
But it's there's both sides to it. So yeah, I really don't have any answer to this. It's just really interesting to me to think about. And it's interesting to me to think about in the world that I live in part of the time and you live in all the time, which is this world of financial advice. What does it mean? I don't think a bot is going to be when someone's panicking because the market's going down. And, a big part of that business is coaching and helping people get through things. I don't think they're going to be typing into the bot or talking to the bot once the bot becomes a person, which is going to be. I don't think they're going to have their bot call Matt Ziegler's bot and have a discussion about this, without you two having to get involved. So that part of it might be pretty protected. But if I think about asset allocation and building a portfolio for a certain person's needs, a lot of that, bots are probably going to be able to do a lot more than we think. So I think about in the business we're in, what can be our moat, how it's going to change. And we don't have any answers to it, but I think everybody should be thinking about it, not just with respect to financial advice, but with respect to what they do.
It's also, I think, tremendously important to remember anything with a bot. There's a big difference in looking backwards versus projecting forwards. And the bot is going to be, and will probably grow in its ability to be really, really good at dealing with all those prior circumstances. But just like us, just like humanity, going forward, it might be able to reduce some of those mistakes, but that's not always a good thing. Sometimes going forward in life, the little mistakes, the little things, even if they contribute to new learnings or don't contribute to anything useful, that's kind of the magic of life. It's the magic of the accidents. It's the magic of the other stuff that just you learn through those experiences. It really, him talking about it shifted that emphasis on what actually matters is the way you're going to mistakenly stumble your way forward through life. And if anything, the better the bots get, the more experimentation you might want to take with your faith, with your ability to let go of that dogma going forward, because you're going to want to tinker and experiment and do all these things more, because you want to do stuff outside of the bounds, outside of the parameters of what a bot's going to do when it's being hyper trained on all that past looking data.
Yeah, my take right now is the people who figure out how to use this to supplement themselves are going to be the winners here. I always go back to this quote Rob Arnott had when he came on Excess Returns. He called like all of research affiliates together, and he basically said, AI is not going to take your job, but someone who learns how to use it is. And I think that is absolutely the right way to look at this right now. Like, I don't think we're going to have like AI financial advisors that are going to be taking over the financial advice industry in the next 12 months. But I do think you and what you can do for your clients and your ability to prepare when you're talking to your clients. And if you're really using this technology, you're going to make yourself much better. You're going to free up more of your time to do other things. You're going to free up more of your time probably to talk to clients, which is like one of the most important things that a bot's not going to be able to do. So I think that's the way to look at it is, where is my true value? Where is my moat against my bot? And how can I use the bot to do everything else so that I can really like focus on my true value?
Which is why we have Rob Arnott's quote hanging above the door of our San Francisco office.
That's right. You got to put it there. Yeah, I absolutely agree. It's a beautiful office, Matt. I really love it there.
So I think about this a lot, though, that it's the bot army, and I do feel like this is a big part of it. And I actually do think of it as like a bot army. There's no unifying bot. We don't have like the one supercomputer that can go out and do everything right now. But we are starting to see the advent of all these little bots to help us with all these little different details and tasks. And they're really good at those micro details and those micro tasks. So I look at the future profession of advice, the future profession of the entire finance industry, of who's going to be able to collect up and build and manage those little bot armies to help them with all those tasks. And you know what? The crazy part is, as opposed to just making an old part of life simpler, which there's some of that, although I've been less enamored with a lot of those things right now, I'm more enamored with the stuff that was a little bit hazy or really hard to do, or the lift was too much. You know, analyzing the tax return all the way through was always a nightmarish thing. But now there's bots that can help us do this stuff and focus in on little different areas, like, oh, you're going to take this distribution because you're buying this house, or this thing is going on. It's going to screw up the IRMA adjustment on your Medicare. And we just want to make sure so you don't get the surprise bill and blah, 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 blah. And it's like little stuff like that. That was a important detail, but a really huge lift. That army of bots totally changes the nature of the advice we can give, the quality of the conversation we can have with the client. That's friggin' amazing. And that's the part that's already here. So if this keeps progressing, it's totally in the hand of not just the one bot to rule them all, but are you going to learn to be a generalist or a general, I guess, at the front of this army of bots that helps you do the job and deliver the task? Because it's, holy crap, what a scale advantage.
And to your point on the tax return, that type of mechanical stuff is where it's really going to add value, and it's also going to prevent mistakes. Like a person reviewing some extensive tax return might miss something. They might miss something on there that you should see. Like when these things get really good, and they are really good now, like you're going to be able to have a high level of confidence that it's gone through the whole thing and that anything you need to brought to your attention is there. So it's not only a time saver, but it's probably going to avoid some mistakes for these mechanical processes that a person might otherwise make.
We found mistakes from otherwise good CPAs, and they're just honest. It's just like for anything that's purely quantitative and very low on the qualitative scale, it can be a really great fact checker. It's a better version of spell check, even if that's an oversimplification of what it does. But in some cases, just a better version of spell check. Hey, even the spell check I use, even like Grammarly plus whatever the default Google thing is when I'm like editing things that I'm writing. It's amazing how far along those have come. And it's also super annoying how many things I have to be like, no, I don't want the most premium service you offer, even though I pay for some of this stuff. It's crazy.
So this next one, we'll do a couple more here, but this next one was great for me. You asked him about this at the beginning, and this is like, I feel like this is directed directly at me because I am Mr. Spreadsheet. So here he's talking about the importance of story in valuation.
It reflects something else I started saying. I've taught valuation now for close to 40 years. I did my first valuation in 1981. I did it with an annual report and a ledger sheet, a paper and a calculator. That's how old I am. But one of the things I noticed as I looked at appraisals and valuations is our access to data became much better. And we could, you couldn't go to S&P Capital IQ Facts and download the last 25 years of data, not just in your company, but in every company in the sector. in seconds. You have more powerful tools. I work with a calculator and a pencil. You have Excel spreadsheets. You can build macros. If you're really sophisticated, you can bring in Python. And I noticed a contradiction. We had more data, more powerful tools, and our valuations were actually became qualitatively worse. The question I started asking is, what's going on? Why is the data and the more powerful tools not translating to better valuations? And my answer was, and I could be wrong, is that we've forgotten that every valuation, you're telling a story. Whether you like it or not, when you put numbers for a company, you're telling a story about the company. And it's your job to make the story explicit and ask yourself, do I buy that story? We've forgotten that art of storytelling because much of valuation has become financial modeling. You're an Excel ninja. You know what buttons or what keys to hit to turn every other row a different color, but you've forgotten that every valuation is a story. So that book reflected the reality that we've forgotten the art of storytelling, and that without stories, valuations has become numbers on a spreadsheet. So that book actually reflected my desire to bring back stories to valuation. Something that I've had a role in driving out, because people looked at books like mine and thought equations and models would basically give them valuations. And it was my response to saying, look, you might have learned all these tools from my books, but they're not going to help you value companies unless you understand how to tell a story about a company.
Yeah, I think this is really interesting to me, and it applies everywhere, I guess, but it particularly applies to like early stage companies. I mean, so much of the value of the valuation of these companies is they're telling you a story with respect to what they're going to be, and you're trying to use that story to try to figure out what it's worth. And there's probably no one better than Musk to think about this. Like, if you think about Elon Musk's career and what he's done, I mean, he's told stories about cars and self-driving, robo-taxis, solar roofs, digging tunnels under cities. He's putting stuff in people's minds. He's got rockets in space. Like, if you're going to figure out what the value of any of that is, like, the idea is which of these stories are legitimate, which of these stories are going to become massive things, and like, how do I think about valuing it? So there's no way to avoid, there's no way to use the spreadsheet and just put numbers in there. There's no way to avoid the impact of the story on this stuff.
The thing that I love, and his new book, outstanding, super, super interesting. The older book that we mentioned, the one that's all about narratives and numbers. You have to understand the story and then the layers of story within the greater story. And the Musk example is a profoundly important one because you can't forget life cycle from the story, which means you can't forget the phases of the story, and you can't talk about it without not talking about all the different layers of that thing that are going on. So you have an idea, like the total addressable market thing. You have this idea and you're like, hey, we can go after this whole market with this stuff. Well, now the story starts where you are first identifying a problem, then saying, I have a profitable way to solve the problem, then saying there's somebody who wants to pay me profitably to solve that problem. And now that I have to build this thing, I need somebody else to give me money because I don't have anything to sell yet to potentially fund my venture so I can solve that problem for those people. And then I have the money, but then I got to get the people who are willing to build the thing to solve the problem and make sure that can still be profitable. As that scales, as that snowball rolls, the story keeps changing. And as that snowball gets really, really big, potentially, if you're successful and keeps rolling further and further along, all those things keep changing because now you could be 20 years long in the tooth and trying to keep people on board. He told the Yahoo story. I remember with Marissa Mayer when she came in to run this and was yelling at all the people to stop working from home and all the shenanigans that went on with that. Those are the layers of stories. As much to convince the shareholders of what the right activities are, as much to convince the activists who came into that company and try to like break it apart for pieces, which they ended up succeeding in doing. There's just thinking of this in those layers is such a profoundly important piece. I will add though, in your defense, Jeff, to the spreadsheet people out there in the world, of which I have many sympathies for, this concept of the spreadsheet as another form of poetry, of another way to reflect reality, you really do need to bring those together and integrate them. Nobody does it better than him in my book because he gets how to build out that model and think about those things. And what more is poetry than just a description of reality in some other terms, in some way where you're like, this actually gives me an accurate depiction of this thing. And yeah, you can use the most flowery language, or you can use friggin' numbers in rows and columns. But that idea that you can understand there's a connection between what's going on in the world, my description of it, and then all the different layers that it's operating and functioning in this model of it that I am building, that is a profoundly beautiful statement. So I think there's poetry in that Excel spreadsheet, Jack.
So you're saying I can put poet in my Twitter description now of who I am?
I insist. In your San Francisco office LinkedIn ID, you add resident poet, resident Excel poet, Python poet, maybe. That sounds dirty. Don't use that one. HR will get on you for that. Yeah, something like that. You're clear.
The other thing you said that I thought was important is it is across the whole life cycle. Like I was talking about early stage, but like we talked in the podcast about Intel and Starbucks, which are both companies that are maybe in the decline phase now, and they need like a rebirth story. You know, Intel, maybe it's around AI. Starbucks is struggling with online ordering versus the experience. So like those companies have to tell a story right now to figure out like, how are we going to change things? And then people that are valuing those companies have to like evaluate the merits of those stories and how it'll impact their cash flows in the future. So there's no way to get around this. There's no spreadsheet that's going to help you solve Starbucks problems right now, because you have to figure out what it is they're going to do, whether you believe their story, and how that impacts the future in order to value the company.
Yeah. And in your model, you're going to see the stories in those layers, because you're going to say, okay, here's what the CEO says they're going to do. Okay, do they need more money to do that? Do they need to keep shareholders happy if shareholders are dumping shares? Like, what are the things that now not just is the story from the company out, but what's the story shareholders are telling? What's the story bondholders are telling? What's the story employees are telling? And do they want to come in and work at this place or they not? Are they like, everybody calls out at, 6 a.m. and 7 o'clock at night, but we're going to stubbornly refuse to stay open in these places. There's lots of reasons where a story's interpretation can adjust not just the price of the thing that you're investing in or thinking about investing in or evaluating or valuing, but how all those stories are going to stack together to say, is this a good story? And is this a good story is an integral question to asking, is this a good investment?
So for the last one, since it is our closing question of the podcast, we should do this. And I love asking people this question, which is, if you could teach one lesson to the average investor, what would it be? And I especially like asking people like Aswath this question, because they don't get asked it very often, and they've learned so much from what they've done over their career. So it's always interesting to see like what they break it down to. So here's his answer to the average, the lesson he would teach the average investor.
I think it's a lesson that increasingly is getting lost. Investing is about preserving and growing wealth. It's not about getting rich. And I think it's somehow these days of YouTube celebrities telling you can get rich again. I was just watching a PBS documentary on crypto and how people want to hit the jackpot. I think that going for 10 baggers, 100 baggers, again, think of how much we go after those. That's not the name of investing. Is about preserving and growing wealth. Would I like to grow wealth at 50% a year? Yes. Would I like to have a 100 bagger in my portfolio? Yes, but I shouldn't be actively looking for those things, because if I look for those things, I'm going to miss the core tenets of investing. So I know it's tough to follow when people around you are getting rich effortlessly. The guy who bought Bitcoin at 100 and sold it at 5,000, you say, I'm working so hard to get a 15% return a year, and there he made 50 times what he... I think that's why looking at other people, letting envy drive what you should be doing as an investor can be extremely dangerous. So keep your focus on preserving and growing wealth, which means you need the income to create the wealth. So if you're a doctor, go back to being a doctor. Don't spend your lunchtime looking at what stocks are doing, what your portfolio is doing. Read up some medical stuff. If you're an engineer, be an engineer first. Live the rest of your lives. Don't let investing become the center of your universe, because you need the income from whatever you do to create the wealth, which you can then preserve and grow. But in a world where markets, and I think that watching CNBC all day is a recipe for a terrible investing philosophy. So spend less time kind of tracking markets on a minute-by-minute basis, reading everything that's happening. Go back to living the rest of your lives and let investing do what it's supposed to do, which is take the wealth you accumulate from the rest of your life and preserving and growing that.
So yeah, I love this idea on preserving and growing wealth. There were a few different levels to what he talked about here. Focusing on preserving and growing wealth was really important. And he talks about the idea that you don't want to take unreasonable risks in your pursuit of that. And I think the more important part was he focused on, and we've had a lot of people who've given a similar answer here, the idea of focusing on your human capital. the idea that, if you're a doctor, go be a doctor, focus on preserving your wealth and then go be a doctor. If you're going to be, most people who have been successful, who we've seen, have been successful because of their human capital. They haven't been successful because they took a flyer on some company in the market and it turned out to be Apple. Like that happens certainly, but it's not the common thing. So I like sort of the multiple layers of the way he did this.
It's the what are you bringing to the table question again from the factor investing thing. What are you bringing to the table? What's the net profit of what you bring to the table? And then what can you do with the net profit after you've done it? For most people, the trade-off of time that they get from their day job, from their profession, and maybe to a degree from, your passion projects, your hobbies, whatever else too, if they bring anything extra in. And if they don't, maybe they allow you to do the other thing better. But this composite view of what are you bringing to the table, what's left over, and then how can you be thoughtful with it? Suffice it to say, there's not a lot of people staring into their phones, trading stocks or cryptocurrencies or 0DTE options or something, who can actually turn around and go like, okay, this is a viable contribution where I'm bringing something to the table. And this is an actual, rewarding lifetime, let alone career. That's a really important thing to just step back and understand and say, what's the driver of value over time? What's the driver of growth over time? What's the driver of just profitability over time? That means this is a sustaining concept that I have faith in continuing.
And this gets back to our original thing about like actively managing your portfolio, because when you're doing that, you are taking time away from whatever else it is you do. And if you're better at that than you are at managing your portfolio, and you don't love managing your portfolio enough to overcome that, like that might not be a good use of your time. So, and that's why I was saying before, like most people probably shouldn't spend like tons of time actively managing your portfolio, because if you're a great doctor, the world is probably better served by you being a great doctor and buying some index funds or something like that. So I think it's just important to keep all this sort of ties together when you think about it. And it's just about using yourself as a resource in the best way possible. And a lot of times that's not managing your stock portfolio.
Proactive, inactive investment management. Can we put a label on that? Can we turn that into a thing?
Trademark. I got it.
Trademark.
I'll file it.
Make sure you lock that down.
So yeah, that we got through 7 of them, and I think that's great. And we're trying to do more of these. I mean, there's so many great lessons in these things, and I always recommend people listen to the full interview, and I particularly would with this one, because we can't do justice. I mean, we used a lot of clips here, but we can't do justice to all the stuff that was in there, and there's a lot more in there than we just put in these clips. So it's on the Excess Returns channel. You can see it has way more views than anything else we do, so it'll probably stand out. But thank you everybody for joining us, and we'll see you next time.
Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbono, and follow Matt on Twitter at @CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.